Okay, guys, and girls, I think we can get started. Great to see a few girls here. So Melanie and Kim, welcome. Always good when we get a few ladies in the group. Fantastic. So welcome, guys. Today we're going to look at crushing the market with iron condors. So I'm going to share lots of tips and tricks with you guys, share a bit of my process on how I trade, and we'll look at some examples as well. So lots to get through. Hope you're ready to go. Grab some water, coffee, whatever you need, and let's get started. Just a quick reminder that anything discussed today is for educational purposes only and should not be considered financial advice, investment advice, or a trade recommendation. And no representation is being made that any portfolio will or is likely to achieve profits or losses similar to those shown. Make sure you check out the disclosure document, Characteristics and Risks of Standardized Options, available from optionstradingiq.com/risks. All right, so what are we going to talk about today? We'll talk a little bit about iron condor theory, how to choose strike prices, unbalanced iron condors, short-term versus long-term condors, really important concept that I'm talking a lot about these days, how to protect from a flash crash, and we'll look at some examples and some little tweaks and things that you can make. So I see some familiar names here. So Mark and Dave, good to see you guys. A lot of this will be review for you guys. You may have probably been through a lot of this stuff before, but for everyone else, hopefully this is new for you and you guys learn a lot, and shoot through questions as we go, and I'll make sure to answer them. If I don't get to them live, I'll make sure to get to them at the end. And it will be recorded in case you have to jump out. I'll send the recording out to everyone as well. All right, so what is an iron condor? Well, here you can see a sort of sample setup. We're selling put spreads below the market. We're selling call spreads above the market. This is kind of a pretty typical setup for me. I'll be looking at around 15 delta on the puts. You can see that 1440 puts got a delta of 15. The 1700 calls have got a delta of 10. So I usually, I've got a few notes here that there's a bit of skew, much higher implied volatility in the puts compared to the calls. So you can see that column on the right there. Implied volatility on the puts is at 23%, and on the calls it's only 14%. So there's always a lot of skew in the Russell. So for that reason, a lot of the times I'll do an unbalanced condor. So I'll sell more of the put spreads than the call spreads, which helps get it to a little bit more delta neutral. So this trade from sort of yesterday was delta -2. If we had have gone with 5 contracts on the puts, 5 contracts on the calls, I think it was more like a delta of -7 or something like that. So just a little bit more of a negative exposure. So as a starting trade, just to try to keep it a little bit more neutral, I usually go a little bit unbalanced on the Russell. You don't have to do that with every underlying, but there's always a lot of skew on the Russell. So I tend to do that. The last note there, delta dollars is a really important concept that I use in my trading. So really quick sort of explanation. You can see there the delta of -2. It's actually more like -1.7. They don't show the decimals here. This is from Interactive Brokers. If we take that -1.7, multiply it by the index price of 1570, we get -2,673. Now that just basically means that's our equivalent dollar exposure to the market. So if we could buy or sell the Russell index, it would be like having a short position in the Russell index, $2,600. And let's say the market goes up by 1%. We've got negative delta, so that's bad for our position. We're going to lose roughly 1% of that delta dollar figure. Okay, so that's why it's really important to keep an eye on that and relate it back to your position size and also to your account size. You know, if you've got an account size of $50,000, you know, this exposure is totally fine. But if your account size is only $5,000, it's very high, right? You're risking 50% of your account on the short side. Okay, so position size is a little bit too high, delta dollars is a little bit too high. So we've got various rules and things like that you guys may have seen in the trading plan if you've got that. If you don't have it, just let me know, I can send it to you. But lots of rules around delta dollars, when we want to adjust based on that number. Also, a couple of other key rules, you know, the delta of the short strikes, if that gets up to about 20, 25, I'll look to adjust and to play a bit of defense at that point, because I've just found in the past that once the short delta gets past 25, let's say, if the trade continues moving against you, that's when the losses start to really accelerate and sort of pick up steam. So you really want to play some defense before it gets to that point. So a couple of sort of rules there and things to look for. Another thing I'll look at is the delta to theta ratio. I want that to be nice and low. So here we're at under 10%, so that's generally pretty good. So we want theta to be the main driver of our position. We want to be picking up a lot of that time decay. A theta of 27 here on this position indicates that roughly the trade's going to make about $27 a day through time decay. Okay. Obviously, Vega is another thing we want to watch for. Iron Condors, they're a short Vega trade. So if we get a volatility spike, that's generally bad for these trades. So we'd like to have some offsetting trades elsewhere that might have a little bit of positive Vega to help offset some of the negative Vega that we have here. Probably the last point that I'll make on Condors is sometimes when I'm starting out, I'll also start with negative delta, similar to this position, just a little bit, because what can happen if delta and Vega kind of work opposite, right? If the market goes up, volatility usually drops, right? So if you've got negative delta and the market goes up, you're losing on your delta, but volatility is dropping, so you're gaining on your Vega. So they kind of offset each other a little bit. If we started this with, for example, positive delta, and the market actually went the other way and it dropped, we're losing on the delta. We've got positive delta, the market goes down. We lose on delta, market goes down, volatility goes up. It's kind of like a double whammy. We lose on the delta and we lose on the Vega. So a lot of times when I'm starting out, I'll start with a slightly negative delta like this. All right, all good. Any questions? Shoot them through, but otherwise we'll keep going. So delta dollars, really important concept. This is from Interactive Brokers, but you can calculate it quite easily yourself, as I've shown you there. And a lot of other brokers will have something similar, might be called a different name, but very important concept to remember. Okay, so the idea with an iron condor is that the majority of the time, the stock or the index is going to stay within a 1 or 2 standard deviation range. Okay, so this is what we're playing for based on probability. Most of the time, it's going to stay within a specified range. It might go up for a bit, might go down. Majority of the time, it's going to stay within this range. Now, we all kind of know, or you should know, that financial markets are not perfect. This is kind of called a normal distribution or a bell curve. Financial markets don't quite fit into this exactly. You'll find that we do get these 3 and 4 standard deviation moves a little bit more regularly in financial markets than what is indicated in a normal distribution. So we've got to be aware of that, that there is a little bit of risk, particularly on the downside. You get things like the flash crash, which we'll talk about, and these volatility spikes that occur from time to time. So we do sometimes get these 3% or 3 standard deviation moves more often than what the bell curve or normal distribution would indicate. Yeah, Bill, that's right. For the Russell, I'm usually about 10 delta on the calls and about 15 delta on the puts. For different underlyings, if there's less skew, I might be 10 and 10 or 12 and 12. If there's no skew, you can be a bit more even with the strikes, but with the Russell, I'm usually sort of 10 and 15. All right, so this is our risk graph for that iron condor we were looking at. You can see there's a little bit less risk on the upside because we're trading less contracts, but again, that's a pretty standard setup for me. I'm usually pretty happy with a risk graph that looks like that. Trades making about 1750 roughly, and we're risking about 8,250. So that's a return potential of about 21.2%. So that's quite high. Usually I want to be looking at a minimum of about a 10% return on capital. So, some people will trade these 4 or 5 deltas, which is fine if that's what you want to do. They're going to be a higher probability of success, I suppose, but when they move against you, the losses could be bigger because you're, I won't say picking up pennies in front of a steamroller, but a little bit when you're trading those really far out of the money spreads, you're generating a very small amount of premium and you've got a large amount of risk. But this is a pretty standard setup for me. So 20% is a nice return, and I would probably be happy to exit this trade early if I've received 50% of the credit. So that would be a 10% return on capital. If I can do that within about, halfway through the trade, I'm usually pretty happy with that. Probably won't cover it in too much detail today, but the risks with iron condors get a lot greater as you get closer to expiry. I don't know if you guys have experienced this. So there's the last week of an option's life is called gamma week. So there's a lot of gamma risk, which is basically price risk in that last week. So if you hold an iron condor, maybe it's looking fine, you're right in the middle, but then all of a sudden the market makes a 4 or 5% move in a couple of days. You've gone from a winning trade to a big losing trade really, really quickly. Whereas, this particular trade, which is kind of a 2-month trade, is going to generally progress pretty slowly towards the start. And then it starts to ramp up towards the end. The swings in P&L in the last couple of weeks start to get much greater, even if it's a small move in the underlying. So we'll talk a little bit about short-term versus long-term trades. But if you just kind of keep that in mind, that the further out in time you are, the slower the trade's going to move. And the closer you get to expiry, the more your P&L is going to fluctuate, even if there's only potentially a small move in the underlying. That's why a lot of people get caught out with these weekly condors, right? I can't tell you how many times I've heard the same story from people on email over the last 10 or 15 years that, they've traded weekly condors, everything's going great, making loads of money, haven't had a losing trade. And then all of a sudden one trade wipes out like 3 months worth of profits because the market makes a big move. So, not saying there's anything wrong with that method of trading. It's personally just not for me. There's a lot of, I don't like those big losses like that sort of come out of the blue. And the other thing with, when you get close to expiry like that, particularly if you're trading a weekly condor, if the trade goes against you, there's very little you can do in terms of adjustments. Whereas, a 60-day trade like this, sometimes you get unlucky. You put a trade on, the next day the market's up or down 2%, or the Russell, right? And that's kind of a worst case scenario. It does happen from time to time. But with a longer term trade like this, it doesn't get impacted as much. You've got much more time to adjust and get the trade back on track. Whereas with those weekly trades, if you put one on and then the market moves 2% the next day, you're in big trouble. And people will sometimes have full losses on those weekly trades, which is just crazy. I've never, ever in 15 years of trading had a full loss on a condor. I like to try and cap the loss at about 10%, so about $1,000 on a trade like this, and generally don't go over that at all. So you might see these risking $8,000, $9,000, $10,000 these trades, but usually if it goes against you, you can pretty easily cap the loss at about $1,000 and get out pretty quickly. So again, just something to keep in mind for those that like those weekly trades. If it's going well for you, great, but look, eventually they do kind of blow up in your face. Frank is asking, do you typically take off the whole iron condor for profit, or do you scale out? Yeah, so I'll scale in and scale out sometimes. Probably more common that I would scale in rather than scaling out, but yeah, I do both, absolutely. So something that's worked really well for me over the last few years is scaling into positions and just being really religious about it, not trying to time the market with volatility spikes or direction. Just every Monday I open a trade. I do that for 4 weeks. I build the position up 25%, 25%, 25%, 25%. Then I've got my full position after 4 weeks. Leave it on for a little bit. And then as we get closer to expiry, I start to sort of roll it off. So that's something that works really well. Good question, Frank. Nice one. All right, so why do we trade iron condors? Well, they can provide consistent monthly income. They're a high probability trade, particularly when you're out at that sort of 10 to 15 delta. They're usually going to have about a 70-odd% success rate. So if you can have a really good success rate, and when you do have those losing trades, cut those losses pretty quickly and keep the losses under control, they can work really well. That's where I see a lot of people going wrong as well, is they don't take losses early enough. They kind of hold and hope, I would say. And there's a saying in the market that hope is a shitty hedge. You shouldn't be holding a position hoping for it to come back your way. So as long as you can keep those losses to a minimum and not let them blow out of control. And again, keeping an eye on that short delta at 25, not letting it get above that. That's another really good thing you can do to help avoid those big losses. You'll generally do pretty well. They're easy to manage. So once you've got the hang of it, it's pretty simple, really. There's some simple rules that we can follow, again, which I can share with you, which are on the trading plan, sort of been proven to work over the last 10 to 15 years. It avoids over trading. So I see a lot of people, doing lots and lots of trades. They end up with loads of positions. There's this whole kind of trade small, trade often movement. I tend to be the opposite. I prefer to have, one or two big positions that I manage really closely and I watch like a hawk, whereas people who have 20, 30, 40 positions open, it just gets overwhelming. Like, they may be small positions, and if one or two of them move against you, it doesn't matter too much, but they're really hard to monitor, really hard to manage. You end up spending loads in commissions and slippage and things like that. So that's my preferred method. Helps me avoid over trading, just a couple of main trades at a time. Non-directional as well. I don't know about you guys, but it can be really hard to pick direction in the market. There's certain technical things we can look for, but a lot of times it's easier to just trade from a delta neutral perspective. And that's what a lot of the market makers and professional traders do. The big hedge funds, they'll be maintaining a big book, and at the end of every day, they'll be neutralizing their delta. Okay. So non-directional, not trying to predict what the market's going to do, just reacting to what the market does and managing our risk and managing our Greeks. And it's a short Vega trade. So again, we can profit from other people panicking. So there's times in the market when we get these big volatility spikes. They're usually pretty temporary, and things get back to normal reasonably quickly. And we can profit from that by taking a contrarian opinion and saying, yes, volatility is high right now. I'm going to take the opposite opinion. I'm going to go short Vega, short volatility, with a view that eventually things are going to settle down. Okay, so a few key things. As we've talked about a little already, selecting iron condor strikes. There are three main considerations. So where to place the short strikes, talked about that a little bit, can depend on the underlying. I said I like to be in that sort of 10 to 15 delta range. And with the Russell, because of the skew, I'll be sort of 15 delta on the puts and 10 delta on the calls. Whereas with other underlying instruments, they'll be more balanced. It might be 12 and 12, something like that. How wide are we going to put the spreads? Is it going to be 10 points wide, 20 points wide, etc.? Again, that can depend on the underlying. With the Russell, I'm typically 20 points wide, but you can do 10 points wide. Part of the reason for going 20 points wide is because I can trade bigger, I can trade less contracts, there's less commissions. And which expiry month to choose, and we'll look at that in a second when we talk about short-term versus long-term trades. Those are the three main considerations. In terms of the short strikes, as I said, three main ways to choose the short strike. The main one and the principal one that I use is the delta. I'm basically just using anywhere between 10 to 15 delta, as I said. Another way you could do it is you could use standard deviation. For example, you could sell strikes that are 1 or 2 standard deviations away from the current price. And you can also use technical analysis. So you can be looking at the chart, looking at support and resistance levels, and trying to place your strikes above resistance and below support. Okay. And also using a combination of all three makes sense. But you don't want to overcomplicate things. Some traders will just sell 15 delta iron condors no matter what, and there's nothing wrong with that. So as I said, number one is kind of the main thing for me. It's the delta. But then I'm also looking at sort of the chart as well and seeing if there's any technical, support or resistance levels, moving averages, things like that. And I might sort of tweak the level of the delta based on that. So using delta is the most common method. And here we've got a fairly common setup. As I said from yesterday, short puts are at delta 15, short calls are at delta 10. Here's our payoff diagram. So risking 8,230, we could sort of round that to 8,250. potential gain of 1770. And that, as I said, is a return of 21.5%. All right, so pretty standard setup. That's you can't go too far wrong. All right, Kim's got a question. So how did I get delta of negative 1.7? Okay, so it's delta of negative 2, but interactive brokers don't show the decimals. So what I did is in Risk Navigator, I changed the contracts to 50, 50, 40, 40, and then the delta came up as 17, negative 17. So obviously, 10% of that is the 1.7. All right, so what if we take a slightly different approach and sell roughly 20 delta strikes? We get a slightly different looking trade. The Greeks aren't overly different. Vega's a little bit higher, Theta's a tiny little bit higher, but the risk and reward of the trade and the management of the trade are going to be quite different. So you can see here our delta's similar, it's negative 2, Vega, Theta, all pretty much the same. But we've brought the trade in a bit closer. So we're selling the 1480 puts at delta 21, and we're selling the 1680 calls at delta 15, almost 16. So it's a little bit more of an aggressive trade. So it's going to need to be managed a little bit different. Hey, Gary, over your head. Okay, no probs. Shoot me an email and I can point you in the direction of some more beginner materials, and I'll aim to do a presentation for beginners as well next time. So I should have mentioned that at the start. Apologies for it going over your head. But look, don't worry, the more times you hear this stuff, the more it'll start to sink in, and it's, it doesn't take long to learn this stuff. But yeah, shoot me an email, let me know where you're at with your trading, and I can point you in the right direction. All right, so as I was saying earlier, I tend to adjust when delta's at sort of 20 to 25, but we're starting with a delta of 21 and a half. So, our rules in terms of adjusting are going to be a little bit different for a trade like this. Maybe we let it go to delta 30 or something like that. Okay. It's not really my style of trading, doing like this, coming a bit closer, but, maybe that works for some people. Again, you just have to adjust your trading plan slightly and come up with some slightly different rules. So you can see the trade payoff graph is a little bit different. We're risking a little bit less now because we're generating more premium. So we're risking 7,250 for a potential gain of 2,750 roughly. So what's that in percentage? That's 30% or so, isn't it? 37.5% actually. So a much more aggressive trade. Not saying there's a right or wrong style. Try a few different ideas, see what works for you. What works for me is the plan that I've developed for the sort of 10 to 15 delta, but there's nothing wrong with trying this out. Now, you're going to get into trouble a little bit quicker potentially if there's a big move. But you're also risking less capital, you're generating more premium, so maybe it works for some people. Maybe there's times when you do this style of trade and other times when you do a 10 delta trade. You don't have to do exactly what I do. Take some of the concepts that I'm teaching you and develop your own trading style based on that. Everybody's different. Everyone's got different risk tolerance, different goals, and things like that. All right, so pro tip for you guys. As I said earlier, starting an iron condor with negative delta can be a good idea. The negative delta helps to offset the negative vega. If there's a sharp sell-off, it's going to be bad for short vega, but good for short delta. And as I said, if you start with a positive delta, a sell-off will impact the position badly in terms of both delta and vega. So it's that old double whammy that I talked about. All right, second pro tip for you guys. Unbalanced iron condors can be a good way to trade a trending market. For example, in recent years, the market's been rallying pretty hard, and some traders have been burnt on the call side. Trading less calls than puts can help prevent this. Check this out and see what you think. So that first trade we were looking at was a little bit unbalanced. We're doing 5 and 4, whereas this is a lot more unbalanced. We're doing 10 on the puts and 5 on the calls. So we're actually starting the position with positive delta. So again, you can kind of tweak the trade based on where you think the market's going. If you're quite bullish on the market, if we've just had a really big sell-off and we're starting to sort of turn around a little bit and the market looks like it's going to go into rally mode again, there's nothing wrong with starting a position like this if you're happy to take that exposure. You can actually do quite well with a trade like this. If the market rallies, you'll make quite a bit of money off the positive delta, not just the theta. So nothing wrong with that at all. So here's the payoff diagram for that trade. So you can see much less risk on the upside if the market has one of these sort of V reversals where we get a big sell-off, we get a volatility spike. This is where I see a lot of people going wrong as well. We get this massive sell-off, massive volatility spike. They think, oh, great, volatility's gone through the roof, time for an iron condor. But then the market just turns around and just rallies 100 points in 2 or 3 days. And that's really bad for a condor, right? So sometimes doing something like this can work really well. You could also do the opposite if we go into a bear market. It's not something I really do a lot of, but you could sell more call spreads and less put spreads. Okay, we haven't really had to do anything like that for a number of years because the market's been so strong. All right, how wide do we put the strikes? So it depends on the instrument being traded. Russell might be 10 or 20 points wide, whereas SPX might be 25 points wide. There's a lot more liquidity in SPX in those 25-point strikes. For Russell, 20-point spreads mean you're trading half as many contracts. This might be advantageous if commission costs are a big factor. 10 points wide or 20 points wide will perform much the same initially in the trade. Okay. However, when the trade gets close to expiry, the bought options being 20 points away, so a 20-point wide spread, that's going to provide you less protection if the stock or index starts moving close to your short strike. So it's only really a factor if you're kind of taking it close to expiry, which I tend not to do. But just be aware of that. If you're trading wider, those further out spreads or further out options start to decay and become worthless a lot quicker, and they provide a bit less protection. But I'm usually, as I said, 20 points wide on the Russell. How many days to expiry? So really important concept. The most common type of iron condor is a monthly trade, so around 30 days to expiry, sometimes 45 days, all right? Some people prefer to trade 60-day condors, and some people will swear by weekly condors. The main thing you need to know is that shorter term trades will fluctuate more quickly and require more trade management. With longer term trades, traders do not need to react as quickly. All right, so one thing I've been doing the last couple of years, and it's partly been out of necessity from moving out to Melbourne, and there's an issue with time difference. The markets for me at the moment are open from 11:30 p.m. till 6 a.m. I can't be in front of my computer all day or all night, right? I need to sleep. So I'm actually going as far out as 150, 180 days with condors, and those move really slowly. So we could compare two trades, and we do this a lot in the mentoring group that I run. We'll look at a 30-day condor, and we'll look at 120 or 150 or 180-day condor at the same time. Let's say we put those two trades on the same day. The next day, the market drops 2%. That 30-day condor is already in a lot of trouble, and it will have to be adjusted. Whereas that 180-day condor, it's barely been touched, okay? So it can withstand those moves. Yes, your time decay is a lot slower. Takes you a lot longer to generate the return, but they move really, really slowly. And that's great for me because I don't want to be stuck in front of a computer all night. And some of you guys are probably working full time. You don't want to be, having to adjust trades during the day all the time. You get stuck in a meeting, all of a sudden, the Fed comes out with an announcement, or Trump sends a tweet or something, all of a sudden the market's down 2%. You come back to your desk and your trade's blown up on you, right? Whereas those longer term trades, you've got a lot more time to react. You could have that 2% move and not necessarily even need to do anything. You might be able to wait till it's a 4 or 5% move in one direction, then you're like, okay, now I need to adjust. But a 4 or 5% move on a 30-day trade within a couple of days is going to be really painful. So again, just something to think about, something to consider. It works for me, may not work for everybody else, but I really am leaning towards those longer term trades and have sort of structured my trading that way the last couple of years, and it's worked really well for me. All right, what can go wrong? So things can go wrong with Condors, right? Obviously, a big move in the underlying instrument is not what we want. Sometimes it happens. That's trading. It can be especially painful if it occurs early in the trade. I've had it happen to me, guys, all the time. It's just, sometimes it's just bad luck. You put on a trade, the next day the market's down 2%. As I said, one way to manage that is those longer term trades. And another way, as Frank said earlier, is to scale in. So rather than going in with 100% position size on day one, you start with 25%, you wait a couple of days, you do another 25%, and so on, right? But it does happen. So let's look at 3 different Condors that were entered on March 20th, 2018. And the very next day, Russell dropped 2.18% and the volatility spiked as well, as you can imagine. So we're going to look at a monthly Condor with delta of -16, weekly Condor with delta of -12, and a 90-day Condor with delta of -10. So they've all got negative delta and the market's dropped. So you'd think it would be good, right? Now, hopefully you guys have been paying attention and you can answer this question. Which position here do you think is going to do the best, and which position do you think is going to do the worst on this particular day? Number 2, exactly. Melanie's paying attention. Melanie gets it. Exactly. So, and you'll be quite surprised at the level, you know, they've all got negative delta. In fact, the 90-day Condor has the lowest negative delta. So you'd think maybe that one would do the worst, and maybe the -16 delta would do the best because the market's gone down. Here's what happened. The monthly Condor was down $550. You know, painful, not disastrous, but pretty painful. The weekly Condor has lost $2,150 in one day. Ouch. So that's really painful. The 90-day Condor is actually up $100. It's pretty crazy, isn't it? The one with the lowest negative delta actually performed the best. So you can see them here on the graph. Here's the monthly Condor. Started in the middle, we've gone down 2%. It's sitting here. As I said, not disastrous. We can probably adjust. We can, you know, play some defense, roll the puts out a little bit, maybe roll the calls in. You know, maybe we can salvage the trade. Painful, but not disastrous. The weekly Condor, pretty disastrous. And there's not much we can do here. We're sitting at probably delta of about 40, 45 on the short puts. You know, there's really not much we can do here. We could maybe reposition the whole Condor, re-centralize it, and hope, again, you know, hope for the best. Hope it's going to stay there for a couple of days. But what happens if we do that and then the market shoots back up again? Right? It's very, very hard trade. It's very difficult to do anything with this. And just, for me, a disastrous situation that I don't want to get myself into. So 100% avoid those weekly Condors. 90-day Condor, again, you can see this is quite a bit wider. So we've got an 11% margin on the upside, about a 9% margin on the downside, whereas that, if we go back to the weekly, it's only about, what are we, we've plus 5.5 to -0.5, so it's about 6% wide. This one's 12 to -8, so this is about 20% wide. Way more margin for error. And it's still, you know, even though the market's moved 2%, you know, it's still more or less in the middle because it's so wide. You know, it's probably started about here and it's just gone to there. It hasn't really done much at all. We can withstand, you know, even the next day, another 2 or 3% loss before it starts to get kind of painful at 500 down. Whereas if we go back to the weekly, what happens if we sit there and we freak out? We're like, okay, I'm just going to hold it. I'm going to hope it bounces back tomorrow. And then it's down another 3%. We're off the map. Even just 2.5% down the next day, all of a sudden that $2,500 loss, well, 2,100 has blown out to 5,500. And that can happen in the Russell. It can be down 2% one day, down another 2% the next day. All right. So if you panic and you don't do anything, you leave it, you're down 5.5 grand out of your 8,500 at risk. Over 50%, 60% or something, right? Whereas, here we're down 2%. If we go down another 2% the next day, we're only down about 300 bucks on the trade. Hasn't really hurt us at all. And then we can just take some defensive action. We can roll the puts down, re-centralize it, whatever we want to do. So look, as I said, no right or wrong answer, but I much prefer this style of trading. So hopefully you get it now. The further out in time you go, the slower the trade will progress. In other words, a 4 to 5% move in the underlying might see traders needing to adjust a monthly iron condor, but a 90 to 120-day condor may still be okay. Weekly condors move very, very quickly and leave very little chance for adjustment. All right, so I think that's pretty clear now, right? Hopefully you guys, try that out in your own trading and have a look. So one rookie mistake that I see people making, entering an iron condor after a sharp sell-off might seem like a good idea due to the volatility spike, but many times I've seen this lead to losing trades. In recent years, we've seen many V-shaped bottoms with sharp rallies after some panic selling. If a trader was to enter an iron condor at the bottom of the market, the call spreads would quickly come under pressure during a sharp reversal rally. The other thing I haven't really talked about today is you can leg into trades as well. You don't have to, you can do those unbalanced trades that I talked about, or, if you think the market's made an extreme move to the downside, you could sell those put spreads. That's a great strategy. Volatility spiked a lot. Prices of the puts have gone through the roof, so you can get really far away. You wait for the market to rally back, and then you turn it into a condor. So that works really well also. So again, don't be sucked into thinking, oh, the market's had a big sell-off, volatility's gone through the roof, I'm going to enter a condor. Sometimes that's the absolute worst thing you can do. All right, protecting from a flash crash. So as I said, it does happen, these sort of moves occasionally, and there's no fail-safe way to protect against a flash crash. However, one thing you can do is buy some deep out of the money puts, which can provide some protection. It won't prevent losses, but it can help stem the tide until things settle down. Traders will typically purchase a put around delta 2 to 4 and pay no more than about $2 per contract. Okay, so this is at the trade initiation. So they might set up their condor, then to give them a little bit of downside protection, they might buy a far out of the money put for about $2. Okay, so this is what a sample trade could look like. We've got our typical condor shape up here, and we've just bought a deep out of the money put. And you can see that purple line, the interim line, falls off much less sharply on the downside. It doesn't give you any protection on the upside, mind you. So you could still, if the market rallied really sharply, you could still have losses on the upside. But if people are worried about these big downside moves, yeah, same expiry, yeah. Or you can go weekly even. Like if you're doing a long-term condor, one thing I'll do is even rather than buying puts, I'll buy butterflies, weekly butterflies. So I'll say, right, I've put a condor on today. The worst thing that can happen to me is, a 4 or 5% move over the next week. So I'll put on 2 butterflies, 4% below and 4% above, just with the weekly options. Okay, so look, I don't really do this buying out of the money puts. I'd more do those butterflies. But look, if you're worried about a flash crash, this is one way you can help kind of stem the tide a little bit on the downside. The other thing you can do is you can just put on your condor, and I'll try and show you an example of this after. And let's say the market moves against you, it starts going down, and your position's got delta of say plus 20, right? If you want to just really quickly protect yourself from any further losses, just go and buy a 20 delta put, okay? And then you've perfectly neutralized your trade for the time being, right? So that's one way you can stem the tide as well, stem the bleeding. Then you can kind of breathe, think about what you're going to do. Do I want to keep this trade? Do I want to completely close it out? Do I want to adjust it? So that's one thing that you can do as well, just to give you a bit of protection. Hey, Gary. So Gary's question, isn't the whole idea of a condor to limit and know your risk so you don't have to worry about a flash crash? Yeah, a little bit, but look, you're still risking potentially $10,000 if the market drops 5 or 10% in a day. You know, you're going to have a bit of a loss. So some people might want to have a bit of protection. But yes, it's a risk-defined trade for sure. You know exactly how much you can potentially lose, but you know, it's still going to be pretty painful if you lose 8.5 grand. Not that that would happen initially because the interim line, you know, never goes all the way to the bottom. And again, if you're trading those longer term trades, they're not going to be impacted as much. See if I can find a little graph. So in this example, how many lots would I be doing? So this was probably a 5-lot Condor, 20 points wide, and buying 1 put spread. All right, so one other thing I want to show you guys that I haven't actually got in the slides, so I'm just going to try and find it. Some of you may have seen this already, but it's another, you know, just another important concept about volatility spikes. You know, everyone see that? All right, so you've heard me sort of mention that these longer term trades don't get impacted as much. So this is an example of volatility futures. So it shows you kind of the days to expiry and what happened to volatility on Feb 5th, 2018. Don't know if you guys know that date, but that was what's sometimes referred to as the volpocalypse. Volatility jumped about 115%, highest spike ever for the VIX. I think the previous high was like 60 or 65%. A couple of volatility ETFs went bust. It was a big disaster, right? So basically what this chart is showing us is option prices at the front of the curve. So with very little time to expiry, you know, 1 day to 1 week trades, volatility went from about 13 to 33. Massive, massive spike in volatility, right? Even the 30-day trades, 60-day options, you know, big, big spike in volatility. Absolutely crushing any condor that was in this front part of the curve, right? Whereas, you know, where I'm trading 120, 150, 180 days out, the spike wasn't nearly as big. We've gone from say 15 to 20. Here we've gone from 13 to 33. You know, what's that in percentage? A couple 100%. Whereas here we've gone from 15 to 20. So what, 25% is it? Something like that. So really important concept. These, you know, yes, we can be worried about volatility spikes with condors, but these longer term trades don't get impacted as much because, you know, the market says, right, we're having a volatility spike right now. Things are pretty crazy, but I know in the future things are going to settle down, right? Because they generally do. So that's why the back part of the curve doesn't get impacted as much. And the kind of tipping point here is sort of 90 days onwards where the impact starts to become a little bit less pronounced. You know, even sort of at the 60-day point, it's still a pretty big impact. Okay, so again, another really important concept. Some of you may have seen that already, but just wanted to share that with you guys. All right, so we're getting on there for time. What I usually do now is go through some past examples, but there's quite a lot there. So what I think I'll do is I'll send you guys a copy of the slides. There's plenty of examples you can look through with commentary. So you can have a look through those in your own time. And what we'll do is we'll go and look at, you know, how we would set up a trade, a sample trade in today's market. All right, so go to my broker platform. This is Interactive Brokers, so I can help you guys. If anyone's using Interactive Brokers, I've got a few videos I can send you guys on how to set all this up. But basically, you know, let's say we want to start a March Condor, so it's about 6 months away, 180 days. Again, it's going to be low time decay, but it's going to move really slowly. So for me, I just add everything in. I'll go options, I don't want my screens playing up like that. It's really annoying. There we go, get rid of that. Sorry, that was a bit annoying. Okay, so I'll add all the options for this expiry, and then I'll sort by delta, which looks like it already is. And I'll close or get rid of all the ones that I don't really need. You know, the really high delta ones and then the really low delta ones. Probably not going to leave these. And then on the put side, yeah, sometimes I'll leave these little ones at around 2 delta. And then I'm not usually going to need anything more than about that. So we can just clean this up a little bit just quickly. All right, so here we've got our sort of universe of possible options that we're going to be trading. There we go, perfect delta 10. So I'd look at selling the 1820s. And on the put side, delta 15, perfect 1340s. All right, so I pick my short strikes first. Then what I'll do is I'll go into Risk Navigator and I'll set these up and have a look at how the trade looks. Again, this is going to be pretty standard, so a lot of times I won't even really need to do this. Oh, I'm just going to pause the recording. I think that's what's causing the... No, it doesn't seem to be. Sorry guys, this is really annoying. I haven't had this happen before. I don't know if you guys have seen that sort of flickering. I feel like I'm in, what's that movie? Clockwork Orange or something. Try and do this quickly. 1340, 1320. Oh my gosh, this is painful. Sorry guys. There we go, got them on there. All right, so get my strikes in there, 20 points wide. That was the delta I wanted, 15, 10. Just come in here, put in the number of contracts. You know, we start with 5, 5, 4, and 4. And there we go, perfectly delta neutral. Take a look, set the expiry date. Sorry, wrong one. Okay, so there we've got our trade. You know, we're potentially making 2,000 over a risk of 8,000. So 2,000 divided by 8,000, so we're looking at about a 25% return in 6 months. So yes, the time decay is low at 9, but you know, who's happy with a 25% return in 6 months? Me, for sure. Okay. And we also don't have to hold to expiry. You know, we look to maybe exit the trade if we make $1,000. That's still a 12.5% return in 6 months. If we can do that twice a year, it's 25% return a year, right? Now, if we add an interim date, you'll see, you know, let's say end of September, see how flat that risk graph is. Let's kind of just zoom into this part here. You know, we can withstand a 6% move before we're down. We're only down $300. So 6% between now and the end of the month, or you know, 6% up is also down about 300 or 400. I can certainly live with that. Now, if I won't add it because of that stupid flickering thing, but if we added in a October condor or 1 month condor, you know, that purple line is going to look a lot different. It's going to be a lot sharper moving downwards on the up and downside, right? Now we've got 15% margin on the upside, 15% on the downside. We're perfectly central, perfectly delta neutral. You know, this trade's just going to sit there and do its thing. And let's choose another interim date. Let's say we go out to the end of October. You know, if we're sort of sitting in a similar area, you know, we're potentially up $400 or $500 by the end of October. And we've got a 5% margin on the downside, 6 or 7% margin on the upside. So that's that's certainly a trade that I'd look at. You know, the other thing you can do If you've got a smaller capital base, you can, as I said, scale into trades. Like I might start this with this position size, then I'd go to 10 and 8 in a couple of weeks' time. And what you can do is you can scale and adjust. So let's say the market goes on a big rally and we're sitting up here about 5% higher in a couple of weeks' time. I'll just add another condor, or the second piece of my condor, at the new strikes. So it's called layering in or scaling in. You know, I can scale and adjust. So the market's sitting up here. I might take these calls off, roll them up, then add a second condor with the same call strike up here at, you know, the 20% line, and add another puts at sort of the 10% line, and just kind of move up and down with the market. Flickering is really annoying. I kind of want to show you the shorter term trades, and I also want to show you how to add a butterfly. So I might just try it. So let's say 4%. Let's say we're worried about a 4% move in the next week. 4% move would be 1640 on the upside and 1520 roughly on the downside. Oh yeah, it's not flickering. No weekly condors. Why is that? Change to weekly. There we go. So I might add a 9 days from now. Oh, and the flickering's back, of course. All right, so 1520, 1500, 1540, and 1640, 1620, 1660. All right, so I put on my condor and I want to add a little bit of protection, and we'll see how this changes things. -2, 1, and 1. So that's our butterfly on the puts, -2, 1, and 1. If we change that to September 27, get this kind of mousy structure. Now, yes, you're going to have potentially losses if it stays flat, right? But it can just help give you protection initially in the trade. And, you know, it tends to work. You know, these condors start to pick up pace as the time goes along. So I'm not too bothered if it sits here in the middle and I'm maybe down a little bit on the trade initially. Let's change it to that date. Oops. And add custom date. I think that's what I was trying to do. Yeah. So something like that. It's not perfect. I'd maybe do it a little bit differently. Maybe I'd go a bit further out so it's a little bit cheaper. But that's sort of the sort of thing I would do. Makes that line a bit flatter. So if we zoom in here with this trade, if we go further out, 6%, we're actually down a little bit more as well. So maybe I'd do it sort of 5 or 6% out. Maybe I was a little bit too narrow, and that would help bring this line back up to 0. So again, it's kind of just playing around with it, finding something that works, right? But you can actually end up doing really well, because if the market does finish within this butterfly, you can actually end up making a nice profit on the butterfly, and then still making a nice profit on the condor as well. So again, that's not a perfect setup. I'd probably be a little bit further away, but the sort of thing that I do as well. And then within Risk Navigator here, you can just kind of turn these off as well for the guys on Interactive Brokers. Frank's saying, do I add protective butterflies each week or only until your T-line flattens in time for the Iron Condor? So I don't do it all the time. I'd probably just do the first week, wait to see what happens with those. And sometimes if I'm really worried that the market's going to make a move, I might do a second one. But usually I just do it at the start. And yeah, as you said, sort of wait till that purple line flattens out a little bit. You know, what else? yeah, as I said, if let's pretend the market's had a big sell-off, we could just start with the put spread, wait for the market to rally back up, and then enter the call spread. We'd then be able to get the calls further away. We end up with a nice wide condor, much wider than we would have initially. Obviously, the risk is that the market continues trending down and moves against your open position. So there is risks to legging in like that. But that can be good when there's big sell-offs. So I was telling you earlier about monitoring the Dow stocks. So within stock charts, you can come in here and do a candle glance. So you go here and then you just do the predefined groups Dow stocks. So these are blue chip stocks, highly liquid options. I'll sort by RSI and I'll look for the most oversold stocks. There's nothing really at an extreme right now. So I'm not looking to enter any new trades. McDonald's is the most oversold, but it's not really that oversold. Sometimes I'll look at also the most overbought stocks and maybe look at doing some call spreads and legging in that way. HD was pretty overbought. I actually thought this was quite bullish recently with that breakout, so I didn't do any call spreads on that one. I tend to be more on the put side. So, a good one from earlier in the year was Walgreens. Let's have a look at that one. Let's go out 1 year. So in through here, just trying to remember, I think I entered the trade in around here when it was about 53. So it had been crushed through here, a little bit of a recovery, crushed, recovery, big drop on earnings. A defensive stock that's massively oversold, down about 40%, a Dow stock that pays a good dividend. So I sold put spreads at like 40 and 35, something like that, I think it was, out in January. So way out of the money, bounced around a little bit, dropped a little bit more, got down to about 49, 48, so showing a small loss at this point on the put spread. But then it bounced back up here. And then, sometimes in early July, I sold some call spreads up at like 65, I think. So I've got this really big wide condor now that expires in January that's doing really, really well. The stock's at 54.84, so it's a little bit higher than it was when I entered the put spreads. And 1, 2, 3, 4.5 months have gone by, so those put spreads have done really well. And it's roughly the same price it was when I sold the call spreads, and 2.5 months has gone by. So those call spreads are doing pretty well as well. So that's something to look for. Just another thing that I've spotted here on the chart, sometimes technical analysis does work. And one of my favorite things to look for is divergence. Stock's making a new low, but the indicator's trending upwards, really strong divergence there. Similar on RSI, it's kind of, deeply, deeply oversold here. It's sort of trending up a little bit, making higher lows on the indicator while this stock is making lower lows. That's a really, really good signal to look for. Did the same earlier in the year on Apple. Around a similar time, around May. Didn't get the exact bottom. I think I entered it when it was about 180 or something like that. Dropped a little bit further, but again, was able to ride it out because those long-term trades didn't get impacted that much. Now Apple's rallied back up, and back here sort of end of July when we got this spike up to about 215. I sold the call spreads up at 240, I think, 240, 250. I did have to adjust them recently when we got this little spike here. I rolled them out another 10 points. But again, I've got a really massively wide condor. I think initially I sold the put spreads at 150, 140, again expiring in January. So I've got this huge condor on Apple that's going to be profitable between 150 and 250, right? So that is definitely something that I look for. If you've been on my webinars before, you probably know some of the other tools that I use. Stock Screener here in FinViz is really good. Looking for large cap stocks in the S&P 500 with good volume that are overbought. So, you can hover over here and have a look at certain stocks that are really overbought, and maybe look at selling some call spreads and legging in that way. the market's been pretty strong lately, so there's probably going to be 0 stocks that are oversold. There's only one, Altria, deeply oversold. Probably not a company that I want to take a long exposure on, because of the industry it's in, right? And the world's kind of getting a bit healthier, so smoking's kind of frowned upon these days. I think this stock just continues going lower probably, but sometimes you'll see some opportunities come up there. I think that's about it, guys. We're getting up towards an hour, so I don't want to take up any more of your time. Not a little watch list I've got there. But I think that's it. Unless there's any questions, what's my typical adjustment? A good question, Frank. All right, so I think there's about 10 different ways you can adjust, but keeping it really, really simple. Let's say the Russell rallies, this gets to delta 25. There's one primary decision you're going to make. You've got to decide, are you playing defense or offense, right? If my delta here gets to 25, I'm definitely playing defense. I'm rolling these strikes out, okay? If one of my other adjustment rules gets hit, but neither of these are at delta 25, I don't need to take defensive action on that short strike. Let's say the market's rallied. This has gone up to about delta 18, and one of my delta dollar rules gets hit. I don't need to take defensive action here on the calls, but I might play offense and roll the puts up a little bit. Rolling the puts up brings in a little bit of extra premium, and also helps neutralize my delta. Other things you can do if you're confident that this strike is going to hold, and you don't want to play defense, you don't want to move it, you could put like a butterfly around that strike. So that helps give you a big profit zone around that strike if you think it might get up around that level by expiry. You can reposition the whole condor. You could add contracts to the put spreads. If the market's rallied up, you want to play offense. Maybe you go to 7 contracts here, brings in a bit of premium, gives you a bit more positive delta. Remember, if the market's rallied up, you're probably sitting with negative delta. So by doing that, you're adding some positive delta to get back to delta neutral. That's something you can do as well. So, yes, there's like 10 different ways you can do it, but sometimes it's best to just keep it simple. Are you playing defense or offense? Firstly, if you're playing defense, you've got to roll them out first and foremost. If you're playing offense, you can roll them in. Sometimes you can do a combination. You can roll the calls out, you can roll the puts up. You're basically repositioning the whole thing. We could literally do a whole hour or 2 on adjustments. So, I won't go into too much detail there, but, that's the simplest way to do things, is just to roll the spreads up and down. All right, guys. Well, I hope you enjoyed the session. I'll stick around for a few more minutes in case there's any questions. Otherwise, if you think of anything afterwards, just shoot me an email as well. No worries, Kim. Thanks, Frank. Thanks, Dave. Pretty sure a lot of this would have been review for you, Dave. I was kind of surprised to see you here, but hopefully you've learned. It's sometimes it's good to hear these things a few times. The more you hear it, the more it sinks in. So hopefully you got something out of the session, and it wasn't too much review for you. Thanks, Owen. Thanks, Melanie. Yeah, rewatch. Yeah, look, we covered a lot today, a lot. So don't worry if it was over your head. If you do have the time to watch it again and just fast forward to certain bits, it's definitely valuable to go through those bits again. But yeah, great to see you here, Melanie. Thanks for your support, and thanks for retweeting. That was great. Thanks, Gary. No worries. Yeah, lots of questions. Shoot them through an email. Always like getting emails from people. Happy to answer any questions. Cheers, Gert. All right, guys, I'll leave you to it. But as I said, any questions anytime, shoot them through an email and I'll answer all of those. and I'll shoot you guys the recording and the slides. And have a great day or a great evening wherever you are, and I'll talk to you soon. Yep, see you next time, guys. Cheers.